Welcome back and welcome to Homes Today. This is proudly presented here by Audrey June Forshey. Audrey is a brilliant RE/MAX real estate agent. She's also an advisor. Today on this set, Audrey has invited Manjeet Singh CPA PC. CPA Manjeet Singh has multiple offices to serve the community. On this set, Audrey questions CPA Singh about the new tax laws for real estate investors. Now, this is a very interesting topic. Let's have a look.
Hello friends, welcome to Homes Today. My name is Audrey Forshey and I'm a RE/MAX agent in Montgomery County, Maryland. And again today, because of tax season coming up, we have our friend Manjeet Singh, who is a CPA in the Falls Church area. So thank you for coming again and helping us and counseling us on our tax information.
Thank you for inviting me, ma'am.
So we talked a little bit about just some general tax rules in our last episode, but today we're going to talk about the new tax laws and how and if they have affected your real estate transactions and how it might be different for you now. So one of the biggest questions we all have is when we buy our house, is our interest still deductible on our taxes? Are we allowed to do that still?
Yes, of course we are allowed to do that. There are two conditions. One, the old law was we were allowed to deduct mortgage interest on debt up to $1 million.
Okay.
And if that rule continues unless you refinance.
Okay.
Okay? The new mortgage interest the new mortgage that you take post December 27,
Okay.
you will be allowed, the max ceiling will be $750,000.
Okay. All right.
Okay? So does it make sense to buy a home greater than 750 or just come up with cash?
It just depends, I guess, on your situation, right?
Yep.
It depends on how much you want to live in that house also, right?
Very true. You want to live in McLean or Potomac?
Yeah. And I guess if the income taxes, if your percentage has dropped, maybe it kind of comes out a little, bit. You have less of an interest deduction on your taxes, but maybe you're paying a little bit less on your tax percentage. Maybe that helps people as well.
That remains to be seen because each tax return is unique and individual.
Of course, of course. So if we have our regular mortgage deduction, a lot of times people will take out second trust or home equity lines of credit to do improvements on their home. Some people put their kids through college, use them for emergency money, just how they have that equity in the home. Is that interest still deductible?
To the best of my memory, the interest is deductible only if you take the loan out and you buy a second home.
Okay, all right.
All right? Just a second home.
Okay, all right. So it can't be for remodeling the kitchen or any of that sort of stuff, as far as
I believe that is correct.
Okay, all right. And then at the end of 2017, we saw a mad dash for everyone going and prepaying their property taxes on their homes. Are our property taxes deductible on our tax returns? Are we allowed to write that off?
Yes, we are allowed to write the property taxes on our tax returns off. The caveat there was, and I was one of the individuals who had promoted it to go ahead and do it. Believe it or not, Fairfax County, in the very first day they started this program,
Yes.
collected $18 million the first day. The caveat here is that the tax should have been assessed.
Okay.
All right? Then it was a deduction.
Okay.
A lot of people came up with the idea, let's pay it just in case the rules change at a later point in time.
Okay.
But it didn't. Instead, the IRS came out and gave out the information that it must have been assessed. Fairfax County, I believe, they do the assessments during the period of January 1st to March.
Okay.
And then they come out with City of Falls Church, they have already assessed it.
Okay.
So the resident of the city of Falls Church, and if they had gone and prepaid it, for them the deduction is valid.
Okay.
Montgomery County, from what I understand, the rule was signed on December 22nd.
Okay.
And on Monday around 4 p.m., Montgomery County sent out an email to all their residents that they will accept it.
Yes.
But the question is it deductible?
Right. I remember that.
As a CPA, I was thinking, who says tax planners, not just tax preparers.
Right.
I was thinking maybe the city council or the board of supervisors in Fairfax County, they should have said, hey, your real estate taxes are assessed as they were with the past year.
Okay.
Pass a resolution to that effect and make the adjustment in the year 2018 for the people they want to increase it to reduce it. But, I'm just a little tiny guy. Nobody listened to me.
Well, I know that a lot of people went and paid them up front in hopes of being able to deduct them. So, so we did talk about the fact that the maximum amount that you can write off interest now is $750,000. So, if I had a mortgage before this tax law changed, and my mortgage was $1 million, I'm still allowed to write that interest off.
That is correct.
If I refinance my $1 million mortgage and I've paid down the mortgage and now I have a $750,000 mortgage, I'm still okay. But if I refinance my $1 million mortgage and my mortgage is $800,000, I can't write off that $50,000.
I believe you could.
You think I can?
I believe you could.
I don't have $1 million mortgage, but
the point here is,
yes,
you cannot do a cash out.
Oh, okay.
Did I hear you properly?
No cash out.
If I heard you properly, you were down to 750 and you are going back up.
Oh,
Okay.
okay.
Or you are below the level and now you are going up to the 750 and not the 800,000.
So my scenario is, let's say I had a $1 million mortgage.
In the past.
In the past. And let's just say through my payments, I've paid it down to $800,000. But I'm not taking money out. I'm just refinancing what I still owe on the $800,000. That's just what I owe. So I am allowed to take the $800,000?
I would say 750.
750. Okay.
I misheard
Okay.
you. Sorry.
Okay, no problem. No problem. How about if some of our viewers have their primary residence here and they live in that primary residence and they get to take that tax deduction? In the past, we were allowed to have a second home where we were able to deduct that interest. Are we still allowed to deduct the interest from a second home?
Yes, we're still allowed to deduct that.
That's because of Congress, isn't it? Don't
Absolutely.
you think?
They have two homes.
They have two homes.
One in their hometown and one in McLean.
Yeah, and
Or
so
Potomac.
they need their
They do
second
need
home
two
tax
homes,
deduction,
yes.
which is beneficial to the rest of us sometimes, right?
Absolutely.
All right, so now that we've kind of talked a little bit about our primary residence, what about if we are investors? You know, everybody wants to get rich off of real estate. It's a business, it's the side hustle. You know, people flip houses,
Yes.
all that sort of stuff. So has a lot changed for my real estate investors?
Not a whole lot.
No?
There was a lot of talk that they're gonna do away with the most favored tax deferring strategy,
Right.
Section 1031, also known as like-kind exchanges
Yes.
or the stalker exchange,
Yes.
but did not get deleted. It's still in place. However, it is only available for real estate. In the past, we were doing the 1031 exchanges for aircrafts, for
Jewelry.
trading of the vehicles.
Oh, yeah.
Capital improvements,
Yes.
not the improvement, but antique items.
Yes.
But all those are off the table. The real estate stays.
That's it. Well, that's good. So
Yes.
if we do that too, so a lot of my investors will do a 1031 exchange. What about you know how you have to live in a property for 2 of the last 5 years to avoid a capital gain for $250 for an individual and for $500,000 for a couple? Is that still intact or has that
Absolutely
changed?
intact.
It is?
Absolutely intact.
Ah.
Even though in the negotiations before the bills were passed or the final bill became the law, The rule, they were thinking about moving the 5 years period to an 8-year period
Yes.
and living in the property a longer number of years, but it survived
I'm very
2
happy
out of the
about
past
that.
5 years.
I'm very
It is
happy
still
about
there.
that. I still have clients that ask me or say to me, I have a lot of clients that are downsizing and selling their large family home now and moving into smaller properties as their children have grown up. And they still ask me about the one-time 55 exemption. And I tell them I'm not allowed to give tax advice, but that's the one thing I know is no longer in effect. It was changed by that 2 of the 5-year living in the property, right?
The 55-year plus option, I don't even remember which year it was taken off the
It's
table.
a long time ago.
It's a long
though.
time. I
Yeah.
think it was during the Reagan years.
That long ago?
I believe it was that long ago. There's no such provision in the current tax law.
Yeah.
And there hasn't been any conversation about it either.
But I still do surprisingly have people ask me about that. So, if I'm an investor and I have rental property, can I still write off the interest and the taxes and the homeowners association? I know that if I drove to my rental properties in the past, I could write the gasoline and the mileage off or whatever you did, how it was done. And are we still allowed to do that?
Absolutely, we're allowed to do that. I want you to think about this way. Owning and renting out real estate is a business activity.
Okay.
Even though it is not active as a trade or business, but it is still a business activity. It is a passive activity. And therefore, under this section 212, 212/162, the deduction is still there, ordinary, necessary,
Wonderful.
and it's in the code section. So, the real estate taxes on the property, whether it's greater than 10,000 or lower, it is a deduction.
Oh, okay.
Mortgage interest, it is a deduction.
Okay.
Homeowner association, it is a deduction. Repairs and maintenance, it is a deduction.
So what about like a capital improvement on a property?
Capital improvement is a deduction based on the depreciation schedules.
Okay.
Okay? Now, real estate, on the rental real estate, the depreciation rules used to be residential 27 and a half years. It's been slightly increased to 30 years.
Okay.
Commercial properties used to be 31 and a half years. It's been increased to 40 years.
Oh, wow.
Certain capital improvement depreciation rate has been increased to 20 years.
Okay.
Whereas it used to be lower in certain circumstances, for example, restaurant improvement and things like that.
Okay, so if I was going to put a new roof on my rental property, I would take the price of that and I would average that over 20 years and write that off my taxes.
Yes.
Is that how I do it? Okay. All right.
There is another rule also there, and I do not believe they have changed it. Does it improve the life of the property
Okay.
to be capitalized
Okay.
for depreciation purposes? Or is it an ordinary and necessary business expense to repair it, to maintain the property?
So what
So
happens?
if it is under regular repair,
Okay.
it is an immediate write-off in the year that you spent the money to fix it.
Okay.
And if it is improving the life of the property, then it is an amortization issue, a depreciation issue.
Okay, very good. And then, if you write that off, I guess you have to pay a recapture, like when you sell the property. So when somebody sells an investment property and they pay the recapture, how is that usually calculated? I know there's a lot of variables that will go into that, but on average.
There are variables, and it's the best part because people do not really understand the implication of it.
Okay.
Because you have been taking the depreciation, you have been avoiding to pay the tax on that depreciation. At the time of the sale, you recapture the full amount of the depreciation you have taken over the years that the property was rented.
And you're
Okay?
paying tax on
Yes, you're including it as part of the income.
it? Okay.
And I call that as phantom income.
Okay.
If you had not taken the depreciation, you need to go back and do a change in accounting method, change in accounting depreciation method, and bring it in so that they offset if you had not done it. Otherwise, you have phantom income on which you have to pay the tax.
Okay, so we should depreciate.
Absolutely.
Okay.
For people who are going to make more than $150,000 a year because of the passive activity loss limitations,
Yes.
you do not get the depreciation. It is better idea to bring it in because when you sell it, you will be allowed to take that off
Okay.
from the gain that you have.
Okay.
Because the time you have been taking the depreciation, you've been reducing your cost basis, and now you have the capital gains there.
Yes.
Or the depreciation part is considered as ordinary and income.
Okay, that's really great information. So I hope that this helps some of our viewers that may have rental properties, just kind of wondering if they're able to take their regular write-offs and how that works. Again, with the new tax laws, I really think that it's important that you maybe consult a professional CPA to keep yourself intact and take the best and most advantage of the new tax laws to benefit you. We thank you very much, and we'll see you next time.
Thank you.